Yeah, I mean, there's always so much changing that you just have to constantly be changing your approach a little bit and asking yourselves how adaptable something is. I often say to people, I like buying businesses that can pivot if they need to, or they can almost self disrupt. So, they're disrupting themselves. And some people say, well, it's better if you buy businesses that don't need to pivot. Maybe they've got recurring revenue, they're nice and stable, they don't need to pivot. And I say, sure, yeah, but it's also great to buy a business that's getting 100% seller financed, is growing 50%
Sure.
year on year. It's like, we'd all like to win the lottery. But I think the reality of online is you have to always be adaptive.
Welcome, ladies and gentlemen. Welcome to another episode of Humans of Flippa, where we deep dive into the stories and strategies of the most influential players in our community, the online business M&A thought leaders. Today, we're thrilled to have Dominic Wells, the founder and CEO of Onfolio. Dom has carved a niche in the digital asset space. He's renowned for his strategic approach to buying and selling online businesses. Very keen eye for the digital landscape, keen eye for online businesses. And today, he's going to uncover some of the methodologies and thought processes behind his success. Welcome, Dom. Thank you for joining us.
Yeah, thanks for having me. That's a nice intro there.
Maybe to make things nice and easy for you, but also to give everyone a bit of context, just introduce Onfolio, the business that you run, and talk us through the methodology of that business.
So we're a publicly traded company listed on NASDAQ in 2022. We're what's known as a micro cap, so we've got a small market cap. And we've been through various stages of evolution over the years, but essentially we are a holding company that buys already profitable online businesses, and we take over the management. Most of the time, sometimes the founder will stay. And we don't ever intend to sell anything that we acquire, although we can't rule that out either. Sometimes it makes sense to sell. So the plan and the vision is keep buying these profitable businesses, growing them, reinvesting those profits into more acquisitions, and rinsing and repeating and scaling up from there. We've got a couple of e-commerce businesses, a couple of software businesses, a bunch of B2B agencies like marketing, SEO, content, email, that kind of thing. A couple of courses, online business course type things, and a small marketplace as well.
Clearly diverse portfolio from and across all different business models. So how does that actually work? Share with us the fundamental criteria that you use when evaluating an online business for acquisition. It clearly doesn't relate to a specific business model. So talk us through that.
Yeah, I mean, that's true. I would say there's still a theme though, which is that they're all obviously online, and the value drivers of the business are all essentially just digital marketing. Sure, there's operations involved, there's people, but generating demand through digital marketing and then selling a product or a service is something which is really the case for every business that we have. And when we first started out, we were really buying content sites. So, your media businesses, your blogs, publishing businesses. And in about 2020, we really pivoted away from that. I think the last content site we bought was late 2020. So when we started out, we were actually a lot more centralized, because everything we're running as a content site, we could have one team that's good at SEO and one team that's good at content creation and another team that's good at project management, and those teams work together across every asset. So it's a lot easier for people to wrap their heads around. Whereas now people see, okay, yeah, you've got like you are almost struggling to get the question out because people are kind of wrapping their head around like, wait, so you've got a little bit of everything. How does that even work? And it's because we're decentralized now. And so sure, there's still some things which are centralized. It's nuanced, but essentially every business we acquire now is its own business. So we've got some link building agencies, and they stand alone as their own businesses. If they were carved out of Onfolio tomorrow, they would still operate fine. The CEOs would probably enjoy not having to worry about public company reporting as well. But that said, we still realize economies of scale sometimes, and we have shared best practices. We cultivate knowledge share and cross-selling and cross-pollination between the CEOs so that everybody gets benefits of being in the same portfolio. But when we're looking at a business, we're asking ourselves, can this business run without the founder? Because 90% of businesses that are for sale, the founder's exiting. Is this something we know how to operate? Even though maybe we're not going to be the ones operating it, do we understand how it operates and where value comes from? And that means that really our business model has changed from being content site operators to really we're in the business of being a holding company. And what that means is we think about, okay, how can we, first of all, acquire a business and make sure that it's going to maintain all the wonderful things that made it a good business. But then also, how can we immediately add value to that business when it becomes owned by us? How can we support the business? How can we make sure that it continues along the path and maintains its autonomy while also being held accountable? And it was interesting because about 6 or 7 months ago, I went to this conference in Cleveland called Holdco Comp, and a lot of everyone there, as you can tell from the name, was a holding co business owner or COO or something like that. And a lot of the people there, some people were rolling up like HVAC companies in Utah, and some people were had a lot of like physical service businesses like plumbing and electrician type businesses and stuff like that. And so going into the conference, I thought this is going to be kind of weird for us because we're online and not many other people here are online. We're probably going to have nothing in common. But what we discovered was we had so much in common because we all had the same questions and problems. Like, how do you incentivize your staff? How do you find good team members? How do you buy a business and have it maintain all this like embedded knowledge that these small businesses have? When you remove the key stakeholder, does the business die? And so really that's like the key thing that I have to grow and learn in my day-to-day business. Like, I'm not really like an agency owner or an e-commerce business owner. I'm a holding co-owner, so it's kind of tricky to figure out in the beginning.
And so you mentioned that there's commonalities between the way you might approach it and the way that a holdco rolling up HVAC companies may also approach it. No doubt is similar for assessing a viable investment. Like what are the factors? I mean, clearly you're online, clearly they're HVAC or other, but what factors make a business stand out as a viable investment for a holdco or frankly for anyone looking to acquire an online business?
Yeah, I think most of the time, like sometimes it gets a bit muddier for strategics because maybe they're buying something for the value of the assets rather than say purely a financial reason. But for most buyers, it's financial, and so you're buying a business really because you're expecting financial return, and usually it's a higher return because there's a higher risk. So you're expecting if you were just looking to get 5 to 10%, you'd probably just buy bonds or the S&P. So really you're expecting to get 15, 20, 25, 30. And so really fundamentally, the first question is, am I going to get that? So if you see a business listed for 10x EBITDA or SDE, that almost disqualifies it straight away, because I'm like, well, okay, I'm probably only going to get 10% return here. So is it worth it? Well, the situations where it is worth paying that much, maybe it's growing super fast, and and so on. And maybe there's a ton of recurring revenue as well. But there's this kind of, I don't know if dichotomy is the best word, but the way we value businesses is really looking back. So you look at their trailing 12 months or their trailing 24 months, and but you're doing that because you're trying to get a sense of what the income's going to be moving forward. And just looking back is often the best proxy. So what did you make last year? 300K. What did you make the year before? 300K. Okay, you're probably going to make 300K this year. But I think often people forget that it's forward looking. Yeah. Which is, they just think, no, it's valued on what it made last year. Well, it kind of doesn't matter what it made last year. What we want to know is what's it going to make this year and the year after. So everything that you're doing is trying to answer the question, what is this business going to make me next year and the year after and the year after? What kind of return am I going to get? What's the IRR or the cash on cash returns? And then once you have that answer, then it becomes, well, how reliable is that answer, or how confident am I in that answer? And if I'm super confident, what things could happen in the future which could disrupt that? So an online business, a content site, for example, before Google kind of went crazy schizophrenic, it was quite reliable. You could see, okay, look, this business gets roughly, say, 1 million visitors per month. Maybe one month it's 800,000, another month it's 900,000, but it's more or less pretty consistent. And maybe that business makes its income from display advertising. Well, that's also pretty consistent. So you can see it makes, if a content site made 200K in a given year, that was probably like 18K a month or 16K a month, and then a big tick up in November, something like that. And so you would feel pretty confident that it's going to make 200K the next year. Yep. But then the question of what things could come along to totally disrupt that would be, well, Google could update the algorithm. This business could lose 50% of its traffic and therefore its income overnight. So that's a risk. And then what are the chances of a Google algorithm penalizing this site? Well, prior to 2019 or 2018, the chances would be, does it have a dodgy backlink profile? Has it done anything kind of shady? Is it using questionable link building practices or anything else deceptive? If it isn't, then that risk is pretty low. But since the Medic update in, I think it was 2018, that question becomes, it's almost like there's 100% chance or a 99% chance that this site is going to be hit by a Google update at some point in the next 12 months. So that makes content sites almost uninvestable for me if they're relying on Google. So with other things, then the question becomes, it's a kind of the same thing. So let's say you have an agency that sells paid traffic. So they help people run their Facebook ads. And they've got pretty consistent revenue. They've got a good source of new leads. Maybe they've maxed out their capacity. So if one client leaves, it's okay because they only need to get one more client in to replace the income. Then the risks become, well, is there a chance that suddenly all your clients leave and you can't get any new ones in? Or is there a risk that suddenly paid traffic isn't a viable agency model anymore? Or is there a risk that without the founder in place, we can't close any deals and get any clients? With agencies, you saw a lot of them struggled in 2023 and a little bit 2022 because a lot of their clients suddenly, the first thing you cut in your budget is marketing, and a lot of people were cutting their budget. They didn't have access to free capital anymore. So that's a risk that probably a lot of people wouldn't have seen coming. But aside from that, the risk with an agency generally revolves around the founder and stuff. And e-commerce, you might say, okay, at the moment, the paid media is profitable, but what happens if Facebook ads stop working or they become more profitable, more expensive? What happens if a competitor comes in with the same products that we've got? So, for example, we were looking at a business for sale on Flippa, which won't talk about it, but we ended up not being able to get the deal done. But that was an e-commerce business that had its own proprietary products. So it wasn't drop shipping. It had a factory in China making its products. And somebody during the due diligence period contacted the factory and was like, hey, can you make this product for me? And they said, no, we've got an exclusivity agreement with somebody else. Yeah. So we were like, wow, that's fantastic. Like that takes away a lot of the risk that, I mean, of course, somebody could go to another factory and ask them to make it, but it takes away a lot of that risk. Whereas if a business is just like drop shipping something from AliExpress, then the risk becomes, well, how easy is it for another competitor to just do the same thing and charge less prices, and it's a race to the bottom?
Yep.
So there's so many questions that you ask, and these are just a few examples I've given.
And Dom, is that why the portfolio is so diverse? Is it partly risk mitigation?
Yeah, it's partly risk mitigation. It's also partly opportunity responding to. I don't know, whatever the word would be for that. We're trying to build something for 10 years or 50 years, maybe even 100 years. And if you keep your scope to more narrow, you have more ability to specialize. But I think your investable universe goes down significantly. Like if we just try to buy SEO agencies, maybe there's only 5 we can buy. And I think concentration risk becomes an issue as well. Like look at all the aggregators. They specialized in theory. They had a very large investable universe, but ultimately they got screwed by the fact that they were all just reliant on FBA and Amazon and stuff. And also I think they did a lot of other things wrong. So it's risk mitigation, but it's also keeping opportunities high. There's a white paper by I think a VC firm, I can't remember their name, but basically they say the ideal investment is able to be opportunistic, so it can respond and it can move into different spaces and take advantage of that. But it's also diversified, so that you're not running a risk of being taken out by one change. And I read this white paper after I'd already created Onfolio, but I realized like, oh yeah, this is really applicable to us. We have the opportunity to move into other spaces if we want to, but we also are diversified enough that we're not going to get screwed by like a Google algorithm change or an Amazon pricing change or something like that.
Let's get our hands on that white paper, Dom. I'd like to see that myself, actually.
I'll see if I can find it quickly.
Thanks, Dom. That's awesome. With the digital market being so susceptible right now to macroeconomic shifts, how has Onfolio changed its acquisition approach and perspective? Clearly now, when did you start Onfolio, Dom?
Very end of 2018.
Okay, so the market shifted substantially since then, obviously, and there's now a new world market which is impacted by clearly trying to understand whether interest rates will stay high or whether, per last week, the Fed might start reducing those over 2024. Other macroeconomic headwinds, including high inflation, but also geopolitical pressure and impacts on supply chain. And you own some e-com businesses, among some other things. So how do you think about doing deals today, and what's different about that compared to the way you did them in the past?
Yeah, I mean, there's always so much changing that you just have to constantly be changing your approach a little bit, and asking yourselves how adaptable something is. So I often say to people, I like buying businesses that can pivot if they need to, or they can almost self-disrupt. So, they're disrupting themselves. And some people say, well, it's better if you buy businesses that don't need to pivot. Maybe they've got recurring revenue, they're nice and stable, they don't need to pivot. And I say, sure, yeah, but it's also great to buy a business that's getting 100% seller financed, is growing 50% year on year. It's like, we'd all like to win the lottery. But I think the reality of online is you have to always be adapting. So really what we're asking ourselves are, what is the risk? Can this adapt if it needs to? And frankly, we're also, the longer we're doing this, the more we're building a muscle. So the more we're getting data and learning what we're good at, and what mistakes we've made and how we could have handled them better. And so we're always looking forwards, but we're also looking backwards, just like, I guess, with evaluating the finances. So I think actually it's also in this this same white paper, which I found now. It's called Complexity Investing, and it's by NZS Capital. I've been away from the UK so long, I don't pronounce it Z anymore. I apologize. But so I think it stands for Net Zero Sum. So NZS Capital, and they've got a white paper called Complexity Investing. So as well as talking about being a mixture of diverse and a mixture of opportunistic, it also talks about good businesses should always be self-disrupting themselves. And I think about online businesses as really good examples of that as well. And when I was growing Human Proof Designs, a lot of what I did was I was always evolving new offerings and being like, okay, here's how we should do this, and here's what else we should sell to our audience. And we never fully disrupted ourselves because we didn't move away from our core product. But I think in order for a business like that to still be successful today, it does need to eventually kill its old offering by launching a new thing. Otherwise, someone else is going to come in and launch it. And with agencies, I think, okay, maybe an agency 5 years ago was selling PBN links. Now PBN links are not popular. Now people do digital PR or they do Harrow. So you can either be an agency that gets taken out by another agency that launches those new products, or you just have to launch them yourself and kind of kill your old business. And then with things like AI coming out, people are always saying, well, don't you think AI is going to kill an agency, or don't you think AI is going to kill this? And it might do, but it also is going to, AI is going to replace a lot of jobs, but it's going to probably create 5 jobs for every job it eliminates. And so for every agency it kills, it's going to create 5 agencies. Or for every agency that dies, that agency is going to be killed by an agency that was using AI. And so I don't want to just talk about agencies, but it's a good example for people to understand. And so a lot of what we're thinking about and learning about is we really want to hold these businesses forever, but the average online business isn't going to be around forever. I mean, the internet's only been around since for me 1990s, and how many businesses are around today that were around like 10 years ago? So if we want businesses to stay around forever, we need to learn ways for them to be kind of agile, not in the the sort of Scrum project management way, but in the real sense of the word agile. And they need to they need to be adaptable. And so really we don't have answers to a lot of the questions about AI. We're just saying, I don't know, but like, let's just figure it out as it comes. And AI is moving so quickly, nobody really is able to adapt to it yet anyway. Because you adapt to something and then OpenAI release something else. So it's kind of tricky.
And so it is tricky. These businesses are so susceptible to great change, susceptible to technology advancements. You've talked about the fact that it'd be nice if they were all super agile and can move into other revenue streams, potentially even other categories, new products, maybe even new markets in some cases. What we've often talked about here at Flippa is obviously acquisition entrepreneurship being safer than the 0 to 1 journey that many people go on. You probably agree with that, I imagine. But presumably there's some failures as well within the portfolio. I know I'm working off script here, Dom, and I hope you don't mind, but for all these businesses that you've acquired, have you found that some are more susceptible to failure than others? And are there learnings from that?
Yeah, I'm trying to figure out if we've had failures, and I'm trying to figure out if they failed because they were more susceptible to failure or they just failed. Sometimes they just fail. There's definitely some that you can try to. There's definitely some that are less susceptible, so therefore there must be some that are more susceptible. But I think, yeah, we've learned. This is what I was talking about earlier when I said acquisition is kind of a muscle, and eventually you make enough acquisitions that you kind of stop making mistakes because you just run out of mistakes to make. It's like, well, we've gone through the checklist. And I think that is like, we can see that our results get better every time. Like the acquisition we made 3 months ago is only 3 months in, but it's looking like it's going to be a really good acquisition. And part of that was because we applied what we learned in previous failures. And I think there's kind of different tiers of failure. There's like, okay, we bought this business and now it makes 0. And that's definitely happened. Luckily, I did it early on with my own money. But then there's businesses where you're like, we thought it was going to make 500K and it only made us 200K. So that's a failure in many senses, but it's also like, it's if you paid with all cash, it's a manageable failure. You didn't get a great return. There's an opportunity cost because you could have bought a different business and made a higher return, but you didn't go bankrupt either. You still, you generated a return. And yeah, I think what we've learned is what we're better at as well, because I think there's good acquisitions and then there's good acquisitions for you. So for someone, buying a software business is a great acquisition for them. For someone else, buying an agency is great. For someone else, it's e-commerce. Which comes down to your preferences, your skill set, your experience, your funding, and your team. So what we've learned works for us won't necessarily be applicable for other people. But I think there's something to be said for just getting in the game and making acquisitions and sort of failing your way to success. Through trial and error.
What would one, if you don't mind, really specific example of a mistake you made on a business that maybe hasn't gone as well as you thought it would post-acquisition? A mistake.
Early on, I bought a content site that got most of its traffic from Pinterest, and so I was super happy to not have something reliant on Google. And then about a month after I bought it, it got banned by Pinterest.
Wow! And
I was like, "Whoops!" And I got it unbanned, and it recovered probably 70% of its traffic and 30% of its income. So it wasn't a total failure, but I was like, okay, all right, that happens. Turns out Pinterest is just as fickle as Google. We've had businesses where I think the biggest one that comes up the most often is just not being able to replace the founder effectively. So maybe the founder didn't even know how much the sales process or the traffic generation was revolving around them. So it's really hard to fish that out in due diligence.
Yep.
So now, kind of going back to a question you asked earlier, like how are things changing? I think we're changing the structure a lot more now. We're trying to keep the founder on. We're trying to do less cash up front, more of an earn out. The market we're in now is a lot less frothy, so you can, I don't want to say you can get away with that because you're not trying to get away with anything, but a lot more founders would take that deal now because they've just got less capital coming their way and all the capital is making the same offers. So just trying to mitigate for potential risks a lot more in the actual acquisition structure.
And Dom, how long on average are you retaining the founder for?
Well, ideally forever, but most founders don't want to stay forever. They don't want to replace. They don't want to, sell their business and get themselves a boss. So it's a little bit dependent on the intricacies of the business, how long you think you need them for. But ultimately, if you're putting an earn-out in place, the founder's going to want to stay to help you until they hit their earn-out. And so an earn-out might be calculated like over a 1-year period. So, a year or so. The key benefit we have as... Sorry, go ahead.
Sorry. Is that earn-out typically tied to revenue or earnings?
It kind of depends on... Like, ultimately, you want it to be tied to earnings. But sometimes it can be tricky to do that because maybe you want to reinvest some of the earnings into growth. Maybe the founder's afraid you can just rack up the expenses. So you tie it to revenue, but then obviously they can generate revenue unprofitably. So you kind of have to tie it to revenue with some covenants that, maybe gross margins have to stay within an acceptable range or something like that.
And so once you've acquired one of these businesses, and this kind of goes for everyone listening in who may consider acquiring an online business, what's your approach to optimizing and scaling it typically? Is it universally applied across the portfolio? Is it distinct? One of the things we've talked about a lot here at Flippa is this concept of stabilizing the patient, i.e. your job in the first 6 or 12 months post-acquisition is just to make sure it runs in the exact same way that it did for the trailing 12. Don't try too much. Don't necessarily even try to optimize it. Just run it in the exact same way. What about you, Dom? Are there specific approaches and or methodologies that you apply universally? And is it across the portfolio or is it very specific to each opportunity?
The way I'm trying to phrase it to people now is it's always something different that's going to grow the business or optimize it or stabilize it, but it's going to be one of these 27 things, and here's how you find out which one it is. And so what we're trying to do is build that playbook and that list of things that people should do and be like, listen, we don't know which one it is for this business yet, here's how we find out, but it's probably going to be one of these things. So it might be improving the gross margins. How do you do that? Well, you either reduce the expenses, you increase your prices, you take some things out of the service or the products that you're offering so that you reduce your costs. And how do you put the pricing up? Well, you look at your competitors, see if they're charging more or they're offering more or they're delivering a better product. How much demand do you have? So it's going to be one of these things. We can't say for sure which one it is. During due diligence, we're going to try to find out as much as we can. And then here's the process that you go through. I fully agree with you, really. The first sort of 6 to 12 months should be, let's just learn the business, find out all the things that we didn't know in advance, try to stabilize the patient, as you put it. Sometimes there's obvious things you can do straight away. But it's still best to only try and do one thing at a time, because if something goes wrong, you can be like, okay, it was probably that thing. So some of the things I would do immediately is if a business has demonstrated that every time it emails its clients, it makes more money, and it's only emailing them once a week, I think it's probably okay to start emailing them twice a week. Especially if that's the only thing you do, because then you can be we didn't make any more money. That's weird. So you can cross that one off the list. The problem is if you're like, okay, I'm going to change the website, I'm going to get a new logo. I'm
Yep.
going to bring, like, the person who bought Human Proof Designs from me. I don't know everything he did, but the first thing he did was switch everyone from Google Hangouts to Teams, because he's like, hey, I'm a Microsoft guy. And I was just, and like, so he got rid of Google Workspace. He just came in, flipped the entire business from Google to Microsoft. And I was kind of like, okay, I'm not sure if I would have made wholesale changes like that. I probably would have just learned Google, but
Yeah.
it's not going to hurt the business doing that. Like, you're not going to, like, the
Yep.
website stayed the same, the logo stayed the same, my face was still there, so that was fine. Whereas you get people that, they come in and they just change everything. And then when 6 months later, they're like, why is this business struggling? They don't know what thing they need to walk back. So it's really challenging.
Yeah, we've I think that the material impact of that can be a function of SOPs being harder to find, converting all of the documents from Google Docs into Word, and actually disrupting the team's operational efficiencies, I would have thought. So that interesting approach, albeit I agree, as long as it doesn't change for the end customer, it's probably okay. What are you keeping your eye on, Dom? What are the trends out there? I mean, obviously, being a holdco with such a diverse portfolio, you're continually thinking about the asset types and all the categories. So what are the trends you're seeing? What are you keeping your eye
on? It's a good question. Right now, I'm really looking for the next kind of obvious win. So, to give an example, when I first started buying sites, I would buy sites that had a lot of traffic, just had like Amazon affiliate, didn't have Mediavine or something like that. I'd buy the business, add Mediavine, and double its income straight away, maybe even triple. Or I'd buy an Amazon affiliate site that didn't have a table of, like, a comparison table, add the comparison table, and most of the time it made a big difference to the conversion. An e-commerce business that doesn't have one-click upsells, usually that's gonna add value. Or a successful course that just has one course, or they just have a bad funnel. So what I really want to buy is a conversion rate optimization agency, so I can learn all the different things, and then I can go out and buy all those things. So like, I find a conversion rate optimization business and be like, we keep finding businesses where just making this one change doubles their income. And I'm like, great, let's go buy those businesses. So I don't actually have an answer right now. And if I did, maybe I would keep it in my pocket anyway. But what I'm trying to find is the next sort of obvious thing that you can do to realize immediate upside, because I think that's a huge, one of our best ever content sites. I think we bought it for 40K and sold it after 2 years. It had paid back 40K, and then I think we sold it for 60K. But 90% of that value creation was done the day we bought it. We just added Mediavine to it. It went from earning 2K a month to 4K a month. And then every time it got hit by a Google update, it eventually went back down to making like a little bit more than it was making when we bought it. And then we sold it for 50% more because multiples had increased and blah, blah, blah. And so it's like getting that instant win just takes so much of the risk off the table. It increases the payback time, it speeds up the payback time, and then it stops working because everyone figures it out, and you have to, sellers start doing it before they sell. But that kind of thing is what I'm looking for next.
And so, I guess just on a similar theme, and this happens all the time for us, we're hosting these meetup series all over the world, Dom, where we meet Flippa community members and obviously talk to them about what their ambitions are, etc. Some are more interested in exiting, some are more interested in buying. A couple of weeks ago in Austin, then Dubai, and then last week we did Melbourne and Sydney. And so many times I'll run into someone who says, I have X amount to spend. How would you recommend I buy my first business? What would you recommend I do? What category? What business model, etc. It's just so common, particularly as we're working in a very still can't believe it because Flippa's been around for a while, as have you, but still very nascent industry, right? Maybe I'll just pinpoint $100,000 budget. Let's assume that I've got a lot more than that at my disposal because I'm not going to burn it all in one acquisition. But what advice would you offer to an entrepreneur looking to buy their first online business?
I guess it depends what they're looking to do. Like if they just want to get a return, like a financial return, I think maybe they should look to invest with an operator. Some of those funds out there, I think that's probably the best thing to do if someone's just looking for a return. But if they want to actually operate a business themselves, they want to learn how to operate them, things like that, then I would probably start out small. The kind of things that like Matt Rard teaches people, like start out with like a 5K site or a 10K site, depends what you're comfortable losing. Not that you should go into it expecting to lose it, but you don't want to be wiped out either. And you'll learn so much from that, that you'll probably do it again another time if you're not too traumatized by the first time. And I've talked about this before, and people have made a valid point, which is you learn a lot more from a bigger business. So like, buying a $500 business or a $5,000 business isn't going to teach you enough. Whereas if you buy like a $500,000 business, you'll learn a lot more. And I'd say that's half true. Like, yeah, okay, of course you're going to learn more from a bigger business, but the risk of being totally wiped out is so much higher that you probably shouldn't take that risk. Whereas if you buy a smaller one first, you'll still learn enough to get better each time. Like going out and buying a business for 4 million with an SBA loan or something is probably not the best approach. Like for every one person where it worked out and was a massive wealth creation event for them, there's all the people that don't talk about it. So they don't tell you how it's going. So yeah, that would be my main my main recommendation would be just get reps in the game and start building that muscle, and do it in a way where like you're not gonna just wipe yourself out if it goes wrong, because the risk of something going to zero is there.
What do you think about if I was to say that buying a $5,000 business makes you far closer to being an entrepreneur than it does an acquisition entrepreneur, and therefore the failure rate could in theory be higher because essentially what you're doing is still operating in 0 to 1 territory versus 1 to 10 territory. Would you subscribe to that view, or would you think that that's fundamentally flawed?
No, I think both those things are true. Like I think it probably does make you closer to an entrepreneur. Maybe a $5,000 business hasn't got product market fit yet. Well, it almost definitely hasn't got product market fit yet. Yep. Is it riskier? I think it's just a different risk. Like it's riskier. The business is more likely to fail, but it's manageable risk. Whereas if you buy a bigger business, yeah, you're an acquisition entrepreneur. In theory, it is less risky, and obviously, you probably you have to subscribe to that anyway. But the risk that you're taking, the risk of being wrong, is a lot more dangerous with acquisition entrepreneur. And I would say, yeah, if you buy a $5,000 business, you're not really an acquisition entrepreneur anymore. But I don't think anybody's born an acquisition entrepreneur. You have to get better at it. So I still think the thing which is going to change someone's life is not buying a $5,000 business and then scaling it. It's buying a $500,000 business or $1 million business and succeeding with it. That is the goal. But I think not many people are going to succeed first time doing it that way.
Yeah.
So it's like take the baby steps first, learn all the things you didn't think about, and then do the bigger one, and you'll be much more likely to succeed with it. So just think of it as like, going through the tutorial before you get to go out and play the game.
So Dom, thanks for that perspective. Yeah. one of the things that I think is still the case in this nascent industry is that lots of the business models, particularly if we're talking about sub $5 million profitable businesses, sub 500, sub 50K, I still think for the most part it's a undervalued and underappreciated space or sector. You may or may not disagree or agree with that, so please do let me know. But what do you think are some of the most undervalued sectors or types of online businesses right now?
Yeah, I think. I mean, I spend most of my time looking at agencies at the moment. I think agencies are undervalued, which is part of why I like them, because they're cheaper. I can get a better return, and there's less competition to acquire them. I think basically people just don't like agencies. But if you do like them, then happy days. It's great for you. I think some e-commerce are probably undervalued. I think a lot of D2C e-commerce has struggled the last few years, and with the higher interest rates, inventory sitting around doing nothing becomes a lot more expensive. Facebook ads are more expensive than they used to be, and so on. So a lot of things have made them fall out of favor, but a lot of them fundamentally are still great businesses. So yeah, that's one. SaaS, I think SaaS is overvalued in some areas, in other areas it's not. I think the thing about SaaS valuations is when they're growing very quickly, they're valued. Mm-hmm. They're valued as a very high multiple, and that's fine. But I think a lot of SaaS founders just see that and don't understand it's kind of all based on growth. So you might have a SaaS that is a little bit maturer. Its growth is flat or like very slow, and they're still expecting 7 times revenue, whereas maybe you should be getting 3 times profit or 4 times profit, because it's still recurring revenue, but it's not like growing exponentially. What else is undervalued? I think online courses can be undervalued because a lot of people are wary of the risk of the founder being like, the heart and soul of the business. And if you can mitigate that risk, then you probably find an undervalued business. A lot of the time you can't mitigate it. So a lot of them are probably correctly valued. Yeah. And I mean, I think overall multiples are down right now. So everything's probably undervalued, but I don't want to say that because I don't want to pay too much for them.
Yeah, I mean, I think there's still they're obviously down across the board. Interestingly enough, I've always argued for the fact that this particular asset class should never be pegged to the NASDAQ or the S&P 500 or others, because you're just dealing with a substantially different size of business, and the liquidity available to the business owners and or shareholders is substantially different too. So they just should be assessed differently. And I think sometimes it all gets caught up in the same space, much like you just said with SaaS. People just come to the table, think that a SaaS business is worth 10 times, when in fact, there's just so many different variables that control the valuation for a SaaS business, and for that matter, any other business. Fantastic, Dom. What's happening with Onfolio next? Is it, batten down the hatches and optimize the existing portfolio? Is it actively buy? Is there any other, or are there any other new ventures or exciting developments on the horizon to wrap us up?
Well, yeah, kind of all of the above. Like that's what we're doing with the existing portfolio, unlocking growth as much as we can. We're currently raising a bit of money to go out and acquire agencies as well, hence me constantly talking about them. We've got a lot of deal flow for agencies, and bringing in some co-investors will help us acquire more. But we're not ruling out other areas either. So we're just leaning into what we realize we're the best at. And then moving forward, we'll probably continue to explore different areas. I've always wanted to go more into software and more into e-com. So we'll do that over time, I think. But really, it's just continuing to learn and hone our tools and get better at what we do and keep compounding. So that's the main story.
Fantastic, Dom. And where can our listeners find you and Onfolio? Where do you want us to point them?
Yeah, so I mean, onfolio.com is the main website. I have a newsletter, which is onfolio.com/newsletter. And I'm pretty active on LinkedIn and Twitter as well, so people can find me there.
Fantastic, Dom. Thank you so much. Thank you, ladies and gentlemen. We appreciate you listening to another episode of Humans of Flippa. Today was Dom Wells. Fairly enlightening episode talking about his acquisition journey. So thank you so much, Dom, for your time.
Yeah, thanks for having me and the great questions.